Lesson 7. Market Efficiency. By the end of this lesson, students should be able to explain efficient market theory and random walk, evaluate the case for passive versus active portfolio management, and describe some well-known market anomalies. The efficient market hypothesis states that in a competitive market with many informed participants, the current price of a security already reflects all known information concerning the potential risk and return of an asset, and new information is quickly received and assimilated into a new security price. Efficient markets react to the continual flow of information about securities. That information is random and unpredictable. Therefore, future prices should follow a random walk. Actually, the random walk is better described as submartingale. That means that the expected price over time is positive. However, random price moves occur around the positive trend. The graphic on this slide depicts the submartingale movement of the market over the long term. Notice the random price moves around the expected long-term upward trend line. The EMH argument that all known information is incorporated within the price of a security has been tested on 3 different information sets: past information, current information, and insider information. These 3 forms are referred to as weak form efficiency, semi-strong form efficiency, and strong form efficiency. Weak form efficiency asserts that all past information is incorporated into the current price of the stock or security. This implies that technical analysis, the study of price, volume, pattern, and time, cannot produce consistent, excessive profit. In other words, there shouldn't be a correlation between a security's past price and the probability of the trend continuing. Because this form of efficiency is only focused on past information, it leaves the possibility that fundamental analysis based on current and projected data may produce superior returns. Semi-strong efficiency asserts that all past and current information is incorporated into the current price of the security. This implies that technical and fundamental analysis will not produce consistent superior results. Because this form of efficiency is focused on past and current information, non-public information, i.e. insider information, may produce abnormal returns. Strong form efficiency asserts that all past, current, and insider information is incorporated into the current price of the stock or security. This implies that technical, fundamental, and non-public insider information will not produce superior returns. So are markets efficient? Does weak, semi-strong, or strong form efficiency hold? The truth is in the market evidence. Empirical data can be examined and conclusions drawn. You will investigate 3 specific areas of data: the assimilation of new information. Event studies are conducted to analyze how quickly new information is incorporated into an asset's price. If the market is efficient, new information is digested quickly by participants, and market prices rapidly adjust. If that doesn't happen, that is evidence that market efficiency is questionable. Active versus passive returns. Returns for active managers are compared to passive, for example, index returns. If the market is efficient, active managers should not be able to consistently outperform passive index portfolios. If managers can consistently outperform passive index returns, then market efficiency is again questionable. Profitable trading patterns. Market return data is analyzed to identify any persistent profitable trading patterns. Profitable patterns should not persist because investors will act, and that action will nullify the profitable trading pattern, making it worthless. If profitable trading patterns persist over time, then market efficiency is again questionable. Testing the impact of new information. Question: how quickly is new information, for example, merger or acquisition, new dividend policy, new earnings guidance, assimilated into the price of a security? The event study. Analyze the security's price prior to the release of information, the day of the release, and after the release. If the markets are efficient, you would expect prices to quickly react to new information. Event study methodology aims to separate the price movement attributable to the general market from that which is attributable to the company itself. A two-factor model describing the normal price movement of a security is: the return is equal to alpha plus the beta of the company times the return of the market plus a firm-specific factor, E. In this formula, the movement associated with the market is alpha plus the market return adjusted by beta. You've already learned about alpha, beta, and market return in earlier lessons. The firm-specific factor, E, is the focus of the study. In this factor model, the event's impact or firm-specific component E is measured by subtracting the actual price return of the stock minus the expected return due to the market adjusted by the firm's beta. Stated as a formula, the event impact E equals the actual return minus alpha minus the return of the market adjusted by beta. For example, if the expected price movement of a security is 2% on a day the market moves 2%, yet it ends up moving 10% following an announcement on the day the market moves 2%, you know that 8% is attributed to the announcement. A 10% stock move minus a 2% market move, leaving an 8% firm-specific move. This event study methodology allows the researcher to pinpoint the effect of the announcement. Let's look at a couple documented event studies and a summary of their findings. In 1980, Michael Bradley's event study, Interfirm Tender Offers and the Market for Corporate Control, was published. A summary of the findings follow. This time series analysis of successful takeovers showed that the price of the companies being taken over had upward drift for some 40 days before the takeover. The majority of the price move occurs on the day of the announcement, and the security's price exhibits random walk after the announcement date. This study indicates that the U.S. markets respond to new information within a day or two. The result of this study supports the efficiency premise because information was shown to be quickly incorporated into a security's price. But let's look at a second event study. This event study, entitled Merger Announcements and Insider Trading Information, was published by Arthur Cohn and John Pinkerton 1 year later in 1981. The summary of this study follows. The time series analysis of 194 firms showed that the price of the companies experienced upward drift of some 30 to 40 days before the announcement. This study confirmed that the majority of the price move occurs on the day of the announcement, and the security's price exhibits random walk after the announcement day. Again, this study indicates that the U.S. markets respond to new information quickly. Based on the findings of these two studies, the market appears to be efficient in terms of incorporating new information quickly. Now let's focus on the efficient market premise that the current price of a security includes all past and present information. A relevant question and a test to prove or disprove the premise follows. Question: can a skilled manager make consistent excess trading profits by timing the markets or by superior asset selection? The test: compare the performance of fund managers with passive buy-hold strategies or index funds. If the markets are efficient, you would not expect active managers to consistently outperform the overall market. If the semi-strong efficient market premise is true, then there is no current public information that can be traded on or active analysis that can be done to produce consistent abnormal gains compared to a relevant passive benchmark. And asset allocation, not security selection or market timing, is the important decision. In an efficient market, passive strategies including indexing or buy-hold make more sense than active portfolio management. Before running an active management versus passive management test, it is important to realize that there are testing problems. Two of these problems are comparability problems. For example, portfolio risk of a small cap equity fund versus the risk of a value large cap fund, and the selection of appropriate benchmarks by portfolio risk. For example, comparing a large cap value manager to a broad market index. Let's begin this evaluation by looking at three different comparisons. The first study compares all actively managed funds with the performance of the Wilshire 5000 index. The Wilshire 5000 is a total market index. The second study compares the investor's return on $1 invested in 1970 in the Wilshire 5000 index and held until 1997 to the return that was realized by Lipper's General Equity Fund Average. The third study compares the 10-year annualized return of all actively managed equity funds with the performance of the Morgan Stanley Capital International Index. The bar chart on this slide shows the percentage of mutual funds that have underperformed the index during the 1972 to 1966 period. In 17 of the 25 years, the index outperformed more than 50% of the managers. The passively managed index outperformed, thus supporting the market efficiency premise. The line chart on this slide shows how $1 invested in the Wilshire 5000 index in 1970 would have grown to $2,592 by 1997. That growth translates into a 12.97% annual return. In contrast, that same dollar invested in the Lipper General Equity Fund Average, i.e. actively managed mutual funds, would have grown to $1,967. The active manager return was 11.87% per year. The result of this study also supports the premise of an efficient market. The third comparison analyzes the 10-year excess returns for all U.S. equity funds in relation to the Morgan Stanley Capital International Index. As you can clearly see, the majority of funds underperform the index. In all three of these comparisons, the passively managed index outperformed the actively managed portfolio. The consensus of results supports the efficient market theory. A retort to the results found when comparing active versus passive performance is that there are consistently good and bad managers. Just give your investment dollars to good managers, and you can outperform the passive index. This retort leads to a very logical question and test. The question: do winners repeat? If a manager performed above 50% in one period, how likely would you also be in the top 50% in the next period? The test: compare the performance of fund managers for one period to their performance in the next period. If markets are efficient, then the chance for repeating outperformance is 50%, i.e. a coin flip. And consistent outperformance is not possible. Let's evaluate the good manager, bad manager argument by looking at two consistency of return comparisons. The first study compares the past annual performance of fund managers to their performance in the subsequent period. The second study compares the 10-year annualized ranking of the top 20 actively managed funds from 1983 to 1993 with their ranking over the next 10-year period. The table on this slide shows the percentage of repeat fund winners over 20 years. For example, 64.8% of the winners from year 1970 repeated as winners in 1971. Winners refer to fund managers that were above the category mean. Evidence from this study shows that while some repeat performance by hot-handed managers occurred in the 1970s, it no longer persisted in the 1980s. The more recent returns indicate there is only a 51.7% chance, i.e. a coin flip chance, of a hot-handed fund manager repeating. The data from this slide comes from a 1995 article in the Journal of Finance entitled Returns from Investing in Equity Mutual Funds, 1971 through 1991 by Burton G. Malkiel. The table on this slide shows how the top 20 U.S. equity funds over the 10-year period from 1983 to 1993 ranked in the subsequent 10-year period. Note that there were 259 funds in existence during the first 10 years. There were 1,016 funds in the second 10-year period. The number one ranked fund during the 1983 to 1993 period dropped to a ranking of 996 over the next decade. The number two ranked fund dropped to a 895 ranking. As you scan down the list, you notice that the drop from high to low ranking appears to be the norm. In fact, only 2 of the original 20 funds remained in the top 10. The result of this test in the 1995 Malkiel study refute the argument that passive-active comparisons are skewed because there are good and bad managers. In contrast, the results strongly support the premise of an efficient market. The argument that active-passive comparisons are invalid because of problems associated with different levels of risk has some merit. Therefore, let's evaluate this argument by looking at several alpha comparisons. In the last lesson, you learned about alpha, i.e. excess return, when you examine the Jensen index. The formula for alpha is the return of the portfolio minus the required market return as defined by CAPM, or the risk-free rate plus the market premium times the beta of the portfolio. A positive alpha indicates good performance. A negative alpha indicates subperformance. The first and second comparisons examine Jensen's alpha for equity mutual funds. If managers have a superior ability to pick winners, then that should result in consistently positive alphas. The third comparison examines alpha for different mutual bond fund categories. The remaining comparisons examine alpha for different expense structures and portfolio turnover rates. The bar chart on this page depicts the distribution of alphas for all equity funds in existence during the 1971 to 1991 time period. The results of this study show a nearly normal distribution function with a mean alpha of minus 0.06. This study confirms that fund managers on average do not add additional value over the expected return of the market. This data comes from a 1995 article in the Journal of Finance entitled Returns from Investing in Equity Mutual Funds, 1971 to 1991, by Burton G. McKeel. The results from a 1965 to 1984 equity mutual fund performance study are depicted below. Notice that all the equity fund alphas are negative. Again, the evidence suggests that mutual fund managers as a group do not demonstrate an ability to beat passive index strategies. The data on this slide are from a study by Elton, Gruber, Das, and Lafka in 1993 entitled Efficiency with Costly Information, a Reinterpretation of Evidence from Managed Portfolios. This article is available at the link provided on this page. The data on this chart summarizes the risk-adjusted return performance of active bond managers. The study measured the alpha of an active bond fund against that of a passive bond index portfolio of similar risk. As shown on this table, the monthly average alpha for the actively managed fund was negative. The negative percentage of 0.107% per month equals approximately 1.25% per year. That amount of underperformance is about equal to the cost of active management and fund expense. The data shown on this slide are from a study by Elton, Gruber, and Blake in 1993 entitled The Performance of Mutual Bond Funds. The data on this table shows the higher fund expense structures are associated with lower alphas. Funds with expenses exceeding 90 basis points had a very higher mean alpha of minus 3.87. Those funds charging expenses between 75 and 90 basis points had a mean alpha of minus 1.68. If active managers aren't able to beat the passive market indexes, then the higher fees would only worsen investor returns. The data shown on this slide are from a 1993 study by Elton, Gruber, and Blake entitled The Performance of Mutual Bond Funds. A summary of expenses for different fund categories is available at the efmoody.com website. The URL is provided on the slide. Similar to the last slide, the data on this table again supports passive portfolio management. Higher turnover rates seem to be associated with lower alphas. You could infer from this data that active market timing strategies do not help investor return. Higher portfolio turnover strategies do not outperform the classic buy and hold strategy. The data on this slide is again from the Elton, Gruber, and Blake 1993 study. Performance studies of active mutual fund managers imply a very efficient market, especially with high frequency occurrences, for example, earning announcements, dividend policy, etc., and with securities that are widely covered by Wall Street analysts, for example, large cap issues. The superstar phenomenon is not routine. Some notable exceptions from more than 14,000 managers have been Peter Lynch of Fidelity, Warren Buffett of Berkshire Hathaway, George Soros, and John Templeton. Burton McKeel's article, Passive Investment Strategies in Efficient Markets, makes the case for passive management. It can be accessed at the following link shown on the slide. Question: in efficient markets, there are no exceptions. Therefore, how can there be a superstar? Answer: two possible efficient explanations for consistent outperformance are compensation for extra hard work in analyzing the mosaic of information to improve forecasting accuracy, and compensation for the ability to dig up implications of private information. Does the evidence support market efficiency in all of its forms? Let's consider three questions. First, is new information assimilated quickly? The answer to that, based on the evidence, is yes. Information is quickly incorporated into security prices. Second, do weak and semi-strong form efficiency hold? Based on the evidence, yes. Active managers do not appear to outperform passive indexes, and repeat outperformance is rare. Question 3. Does strong form efficiency hold? No. Announcements of mergers result in substantial price movement. If the insider information was incorporated, the merger would have already been priced into the acquired company. Up to this point, there appears to be strong evidence supporting market efficiency. Now, let's investigate trading patterns. In an efficient market, any systematic, profitable trading pattern cannot persist. Arbitrage and investor participation will quickly neutralize the advantage, and trading systems will quickly become worthless. So, question: do any repetitive, profitable trading patterns, i.e. anomalies, exist? The test: let's evaluate market returns to identify any persistent patterns. Anomalies are systems or patterns that outperform the passive or buy and hold strategy. Market evidence. Based on the evidence, anomalies persist in several broad categories, including fundamental anomalies, calendar anomalies, and other anomalies. A good summary and explanation of well-known anomalies is provided at www.investorhome.com. The URL to this site is provided on the slide. Some fundamental market anomalies are the small firm effect. Smaller firms tend to outperform larger firms, especially the first 5 trading days of the new year. Neglected firms. Small cap stocks that are neglected by large financial institutions tend to outperform those firms that are covered by Wall Street. Low market multiples. Stocks with low price-to-earnings and price-to-sale ratios tend to outperform stocks with high PE and PS ratios. Some calendar anomalies are the January effect. Stocks, especially small caps, have had their best trading month in January. The first 5 trading days of the new year tend to be especially profitable. The Monday effect. Mondays tend to be the worst day of the week to buy stocks. The turn of the month. Stocks, especially large caps, tend to perform well at the end of the month and the first few trading days of the new month. Some other market anomalies are dogs of the Dow. The 5 worst performing Dow stocks in the past year tend to outperform in the next year. The size effect. Some studies find that small cap stocks, especially micro cap stocks, tend to outperform large caps. And buyback announcements. The stocks of companies that have announced the buyback of stock tend to outperform. How can an anomaly persist in a very efficient marketplace? There are 2 explanations that might explain the puzzle. First, risk premiums. The anomaly return might be consistent with the level of risk assumed. Behavioral finance premiums. The persistence of market anomalies may imply that market participants are not completely rational at all times. Perhaps investor emotion and faulty decision-making processes cause investment choices that are not totally logical. Question: how can a portfolio manager add value if the market is efficient and active management is inferior to passive strategy? First, the portfolio manager can ensure adequate diversification. Second, the manager can assess the risk level of the portfolio and manage tax liabilities. The portfolio manager can deal with liquidity issues. And also, the manager can make sure allocations coincide with the prospectus. In this lesson, you learned about the efficient market hypothesis and random walk. Market tests of efficiency, including event studies and relative performance of active fund managers versus passive portfolios. And you learned about market anomalies.